All right, let's dive in. Today, we are cracking the code on the real language of business. Whether you're thinking about starting your own thing or you just want to understand how the world of finance actually works, knowing how money moves, well, it's a superpower.
So think about it for a second. Every single day, a business makes tons of financial moves. They're buying, they're selling, borrowing, paying employees. How on earth do they keep it all straight? How do they tell their financial story without just getting lost in the noise?
Well, the answer is a skill, and it's called financial transaction analysis. Honestly, this is the engine of all accounting. It's just a methodical way to look at any financial event, anything at all, and see exactly how it changes where a company stands. And today, we're going to learn how to do it. So here's our game plan. First, we'll learn the language itself. Then, we'll get into what I call the golden equation of accounting. After that, I'll give you a 5-step toolkit to break down any transaction. Then, of course, we're going to put it all into practice with some real examples. And we'll finish up with a super simple cheat sheet so you'll have the rules down cold. Every field has its fundamental laws, right? In physics, you've got E equals mc squared. Well, in accounting, we have our own law that's just as powerful. It is the bedrock that everything else is built on. Let's take a look.
And here it is. Assets equals liabilities plus owner's equity. It's so simple, it's beautiful. All it means is that everything a company owns was paid for in one of two ways, either with borrowed money, that's liabilities, or with the owner's own money. And the most important thing to remember is this equation must always, and I mean always, be in balance. No exceptions. It's like a law of nature.
Okay, so let's break down what those terms actually mean. Assets are just the stuff a company owns, things of value, like cash, cars, computers, you name it. Liabilities? That's what the company owes to other people, like a bank loan. And owner's equity? Well, that's the owner's slice of the pie. It's their claim on all the assets once you've paid off all the debts.
Okay, so we've got the golden rule. But how do we actually use it in the real world? This is where our 5-step toolkit comes in. This is the process you can apply to any financial event that comes your way. So here are the steps. 1, you just ask what accounts are involved here. 2, you classify them. Is it an asset, a liability, an equity account? 3, you figure out if they went up or down. Step 4 is where we apply something called debits and credits, which are just the labels for those increases and decreases. And finally, step 5, the sanity check. Is our golden equation still balanced? Theory is great and all, but practice is really where the magic happens. So let's run through some super common business transactions and use our 5-step toolkit to see exactly how this whole thing works. Okay, here's the classic origin story for pretty much every business ever. An owner takes 10,000 dinars of their own cash and puts it into the new company. This is day 1. So how do we break this down?
All right, let's go through the steps. The two accounts affected are cash and the owner's capital. Cash is an asset, and it just went up. The capital, which is a type of owner's equity, also went up. Now, in the language of accounting, an increase to an asset is a debit, and an increase to equity is a credit. Does it balance? Assets went up by 10,000, and equity went up by 10,000. Yep, perfect balance.
Okay, next up, the new company needs a car. So it takes some of that cash and buys a vehicle for 8,000 dinars. Now here's the question. Has the company's total value actually changed? Let's analyze it.
So what's really cool about this one is that everything is happening on the asset side of the equation. We got a new asset, the car, so that account increased. But we paid with cash, so another asset, cash, decreased by the exact same amount. It's basically just an asset swap. The total value of assets didn't change at all, so our equation is still perfectly balanced.
Let's do one more just like that to really hammer it home. The company now needs computers, so it buys 3,500 dinars worth and again pays in cash. You can probably guess what happens here, right?
Yep, it's the exact same logic. The computer's asset account goes up and the cash asset account goes down. We just traded one asset for another. The total value of what the company owns is the same, and our golden equation is still happy.
All right, time for a new twist. The company wants to grow a bit faster, so it goes to the bank and gets a loan for 20,000 dinars. Now, this is different. We're not just swapping assets around anymore. We are bringing a liability into the picture. And this example shows so clearly how the two sides of the equation work together. The company's cash, an asset, just shot up by 20,000. But at the same time, it now has a new bank loan, a liability, which also increased by 20,000.
So assets went up and liabilities went up by the exact same amount. See, the equation is still in perfect balance.
Okay, it's payday. The company pays its employees salaries totaling 7,500 dinars. This is what we call an expense. So where does an expense fit into our nice, neat little equation? This one is super important to understand.
Here's how it works. Our cash, which is an asset, goes down by 7,500. Now, on the other side of the equation, an expense always reduces the owner's claim, or the owner's equity. Think about it. That cash has left the business for good to pay for operations. It didn't get swapped for another asset like a car, so the owner's net worth in the company actually went down. So assets go down and owner's equity goes down, and once again, balance is maintained.
Phew, we've covered a lot of ground breaking down these different transactions. Now, let's just boil it all down into one simple, powerful summary, your ultimate cheat sheet for how all this stuff fits together.
This is it. This is the Rosetta Stone for the language of business. On the left side, you've got your assets and your expenses. Both of these types of accounts always increase with the debit. On the right, you've got your liabilities, your owner's equity, and your revenue. All of those accounts increase with a credit. If you can just remember this simple chart, you can analyze pretty much any financial transaction that comes your way.
By understanding this simple balanced equation and these rules of flow, you've literally unlocked the ability to read the story that numbers tell. And it's the story of every single business out there, from the coffee shop on the corner to a giant global company. So the only question left is, what financial story are you going to uncover next?